What's going on? If you are here for the first time on this channel and आप learn करना चाहते हैं about savings, investments और wealth creation ideas के बारे में, तो this is the place. So without much ado, let's start now.
Often hear people asking questions like which fund is a good fund, is my portfolio balanced, what should be my asset allocation. Once you have done with the requirement of budgeting, setting your goals and identifying instruments etc, one of the key consideration you should give before selecting the funds is your age. The general perception is that if one had more money at one's disposal, one would have a better plan to use it properly. However, the reality is if you have a better plan, you would make more money. Most of us believe that it is necessary to secure our and our family's future, but what prevents us from doing this is the lack of funds. This is where most of us go wrong and miss the early bird advantage. However, with the right planning and approach, you too can achieve your financial goals with whatever little you manage to save. So at what age what should be my holding? Let's answer this question. But before that, a disclaimer: this video and guidance in this video is only for educational purpose only. This is not an investment advice. Your risk taking abilities may differ and hence require proper assessment before jumping on executing any of the advice outlined here in next few minutes. It is always recommended to consult your financial planner before investing. Now that we have talked about disclaimer, here is a good baseline rule of thumb. The 20s investor. If you start investing as soon as you get your first job, it would certainly be easier for you because you will have fewer financial responsibilities and can afford to take risks. There is also an added advantage: you will be in a position to address any mid-course corrections to your portfolio without major hassles. So, when you start out in a game to take risks, your portfolio should be heavy on equity funds, around 80%. But if you believe in conservative investing, you can allocate 60% to equity funds. As a new investor, start investing in exchange-traded funds, ETFs, and index funds. ETFs and index funds invest in the same stocks and in similar proportion as they lie in their benchmark indices, BSE Sensex or the NSE Nifty. They are passively managed with a name to reflect stock market returns. Try large cap equity funds, which invest in well-established top-run companies and are less volatile because they are actively managed and have the potential to beat the stock market returns. Aggressive investors can invest up to 30% of their equity portfolio in mid-cap and small-cap funds. The 30s investor. As you move up the ladder, you might have more or less settled down in life with a higher pay package, but also with more dependents, especially if you are married and have children and perhaps parents to support. Your financial responsibilities will also increase, and to cater to those needs while keeping your capital safe, you need to move towards safer assets such as debt and reduce your dependence on equity. At the same time, you need to invest for your long-term goals such as a house, funding your children's education, and your own retirement needs. Lessen your dependence on equity down to 70% if you are an aggressive investor and 40% if you are conservative. Conservative investors should stick with diversified equity funds, and the ones with more risk appetite must consider mid-cap, small-cap and sectoral funds to get better returns on their overall portfolio. In your 30s or even later, as you scale down your equity exposure, you should review your outlook on debt funds. They must now be seen as growth vehicles. Now all your incremental debt fund allocation should flow into income funds. The 40s investor. Your expenses tend to peak at this stage of your life. You may still be having some medium-term goals to provide for a house or your children's higher education, and at the same time, you would also have to proactively plan for your retirement. Therefore, you need to gain risk and, while doing so, ensure your retirement corpus grows substantially too, with inflation beating returns. To negotiate this tightrope, the aggressive investor should go with a perfectly balanced exposure to debt and equity. However, if you are risk averse, allocate 10 to 20% more in debt. Irrespective of what your risk appetite is, this is the time to scale down your equity exposure and explore debt instruments that would provide stability of returns, such as floating rate funds and fixed maturity plans. The 50s investor. By now, you have either met most of your big money financial goals or are on the verge to close on them. Save your retirement. Whatever the case may be, this is the time to give top priority to secure your retirement by ensuring the safety of your capital and wait for the right time to migrate your money from riskier equity to safer debt instruments. How much you want to move will depend on your risk orientation as well as whether you are planning for a second career in retirement. If you expect to keep earning, you may risk a higher equity exposure. If you intend to live off your investments, increase your allocation to debt instruments. Remember that MF schemes offer some advantage over other fixed income instruments. If you opt for dividend, it is tax-free. However, if you opt for growth option, you will have to pay short-term capital gain (STCG) tax or long-term capital gain (LTCG) tax if you sells the units before a year or after a year, respectively. STCG tax is calculated as per your tax slab and the LTCG tax is calculated at 10.30% without indexation or 20.60% with indexation.
So thank you for watching the video. Do subscribe to the channel and press the bell icon to get notified on the latest videos. Bye for now and see you next time.